All right, good to have you with us. Thanks for joining us. So we are continuing to watch a couple of themes. First of all, the mood of the markets has been very positive. We mentioned all-time highs as we finished out last week's trading. This morning, a little bit of weakness for the pre-market stateside as Donald Trump's tariffs are scheduled to be reimposed Wednesday for dozens of countries. Our next guest says whatever happens between countries like the U.S. and China, there's certainly much to watch. Sadiq Adatia is Chief Investment Officer at BMO Asset Management. Sadiq, it's nice to see you.
Thanks for having me.
Where do you want to start? You want to start with the broader mood of the markets and the resiliency, or this fresh trade uncertainty, which has been a pretty common theme this year?
Yeah, I mean, let's start with the markets. Okay. I would say just, you're looking through things. The market has been quite optimistic about things, and rightfully so, I would say. I mean, the U.S. economy is not slowing down to the extent people were expecting. The U.S. consumer remains very resilient across the board. The tariffs that were supposed to be, dramatic and significantly higher than, initially expected have not transpired. Trump's backed down a few times. And as we look into the earnings season, the earnings still look relatively good. So we're optimistic. We still think markets go higher from here. We're overweight equities, so we just upped that up more recently. And though we expect to see tariffs, be a little bit more volatile in the coming days for sure, we think that the worst on the tariff front is probably behind us. And that baseline 10% looks like a pretty good way to start looking at things, with obviously a few exceptions to that rule.
Okay, so if you say you're feeling relatively good about equities, what does that mean? Like when you look around the world, what's catching your eye right now?
It's actually the U.S. market that is catching our eye. We've seen international and Canadian markets outperform the U.S. We don't think that's really justified at this stage. So heading into the end of the year,
I was saying we're up about 9% for the TSX. The S&P itself on the year is up close to 7%.
Yeah. So I think between that and even international markets, we see U.S. catching up, not fully, but definitely outperforming the two markets from now to the end of the year. And that's really tied back to the resilience of the consumer and stronger earnings. And so the demise of the U.S. economy is far from done. And even the U.S. dollar strength, I think, will start to come back a little bit. I don't think long term, but I just think in this next few months, as we're going through the tariff situation, I think it'll hold its own, which will be good for foreign assets compared to a declining U.S. dollar that would hurt our foreign investments.
In light of just a whole host of factors, whether it's the trade uncertainty, whether it's the fiscal situation in the United States, whether it's the fact that because of some of the actions by the Trump administration directed at the rest of the world, one great example would be the need for Europe to spend more on defense over the long term. You saw what felt like for the first time in a while, this broader narrative from the strategist community that you should be looking beyond North America. You should be looking beyond U.S. Look at what's going on at Europe. Plus, look at the valuations of European companies, even though they've had this nice move. So what would you say to that if you're leaning more to the U.S.?
Yeah, we don't disagree with that.
Okay.
I was actually our call at the beginning of the year. We expected to see a bit more diversification after strong run-ups. The catalyst was the tariff situation for sure. However, what I would say is definitely the defense spending is going to boost European markets. The automotive sector probably will do the opposite. You'll see some decline coming through there. And then you tack in the fact that still, when you look at those two economies, the earnings potential between the U.S. and Europe, significant. And that means that, again, until we see much better recovery on the growth side of the European economy, outside of defense spending, I think it's really hard to get exceptionally bullish in the European markets today, especially, again, where the U.S. still has momentum, still is tied to a lot of the key themes that we're seeing out there. And so we think the U.S. should still be the place you want to overweight. It doesn't mean that we shouldn't have exposure to other markets and be diversified. That you definitely should be doing that, especially if you haven't done that over the last few years.
But it's you're like, because tech had that massive move off the April lows in the U.S. But you're saying, like, when you say earnings look pretty good, you're not just talking about tech, or?
I'm talking more broader. So if I look at tech, for instance, for sure, I think tech is still going to have good earnings across the board. I think you'll see money flowing back in some of those names. Financials is another great one. We just had a stress test on Friday. Great results coming through. Now allows banks to, increase buybacks, increase dividends, potential tax cuts, deregulation. Another area that has a strong momentum, it's actually our biggest overweight, is financials. So it's not just a tech story in the U.S. I think it's a more broader story. And so I think when you're commenting about diversification, I think it's also within the U.S. market as well.
Okay. Financials, actually, we spoke to a technical analyst from Bay Street last week who was saying, don't fight the momentum for some of those U.S. financials. So
I think that's true with the markets as well. I don't think you fight the momentum that's going on in the markets at the moment, financials, and even at the moment, the technology side as well, too.
Okay, so let's just dig a little deeper into Canada, just based on everything you're saying. So we've established that, who knew, outperformance for the TSX versus the U.S. market up until this point in the year, even though there's been so much uncertainty about our economy, what the trade ramifications would be. There was so much talk about recessionary risks, if you think about it, just a few weeks ago. Maybe we're starting to shift a little bit away from that. But you have a couple of sectors in particular, like materials. I mean, that group is up more than 30% this year. That's in part because gold has been strong. I heard you say that you think you wouldn't be surprised to see a little bit of U.S. dollar strength. I don't know what that means when you think of gold, but...
Yeah, so we BMO GAM just did their recent house view meeting heading into for July. And a few things that we changed was we went for the first time in 2 years back to neutral on gold. We've had a great run. We think a lot of the uncertainty for you holding gold is a little bit off the table. You still want to hold it as a hedge against the uncertainty of Trump, for sure. But we've taken off some of that profits there in holding that as neutral. So that's one of the things that we think on the Canadian front, you don't have that tailwind that you had previously. The second part to that is, as you said, the Canadian dollar has strengthened quite a bit, this year. We think it's run up a little too far, too fast at the moment. We think the long-term trend still should support the Canadian dollar appreciating. But I think over the next few months, I think the U.S. dollar holds its own. So you don't get that lift off, from the Canadian versus the U.S. markets. From that perspective. So, and then you added in the comments about the tariff situation. I think the tariff situation will be fine. I don't think we're going to get excessive tariffs. I think we're going to be at a much better spot, especially now we've got the digital tax off.
Yeah.
And that's what I think is leading people to be a little bit more optimistic about Canada, because you might see the Bank of Canada cut rates a little faster than the U.S. from that perspective.
Okay, that's what I was going to ask you, because that's also a factor when it comes to the Canadian dollar. What's your current assessment of where the economy here sits and what the Bank of Canada will do for the balance of the year?
I think the Canadian economy is not very strong. I think you're seeing unemployment still relatively high. I think the tariffs are going to impact us for sure, a bit more so than maybe other countries because of our strength towards the U.S. But I do think the Bank of Canada will start to cut a little sooner than the Fed will. And we expect at least 2 rate cuts this year in Canada. We think maybe 1 in the U.S. And that should help boost a little bit of that consumer spending, but it also should weaken the Canadian dollar a little bit relative to the U.S. as a result of that.